Welcome, everyone. My name is Andrea Armeni. I am the Executive Director at Transform Finance and the convener of the Transform Finance Investor Network. I'm honored to welcome you today for this session of the Investor Network and invited guests on investing in employee ownership through a private equity fund structure. Promises to be quite a great conversation based on over a year of work that we've been doing on this. I will be joined today by Scott Abrams of the Open Society Foundation's Economic Justice Program, and Camille Kerr from Upside Down Consulting, and a longtime collaborator of Transform Finance that is my co-author on this paper, and is, as you all know, if you're in the employee ownership space, a long-term active practitioner in that area with a distinguished past at NCEO and at Dow, the Democracy at Work Institute. Before we dive into the content, a couple of quick updates from Transform Finance. So those of you that have been with us for a while are familiar with our Transform Finance cohort that is on the topic of worker justice this year. It's called The Future of Workers is Now, and it's an effort to support some worker justice organizations ranging from Jobs for Justice and NDWA to the SEIU and the Workers Defense Project to develop a strategy around engaging with capital in new ways and finding pathways to advance worker justice through capital strategies and capital interventions. We will have the next in-person gathering of the cohort on August 8th and 9th. We'll be able to share more with you before then on the specific strategies that the cohort members are developing. We always welcome anyone who wants to support that as a coach or as an expert, in particular since the cohort members are looking at a variety of different strategies that range from venture capital to municipal finance to real estate investment. So if you are knowledgeable in those areas and would like to be involved, please drop me a note. And they will present those strategies to a group of investors from our investor network and ancillaries on November 14th, where we'll be trying to get support for the actual implementation of strategies that they've developed, again, to drive worker justice in the capital context. And also, you'll know about our traditional annual Institute for Social Justice Leaders, our effort to bring together a group of 30 or so social justice leaders from around the country to learn why finance matters and how to start thinking about it, how to start engaging with it. This year, it will be in New York in September. And if you want to learn more, if you want to send the application link to somebody for those 30 spots, you'll find it on our website or at bit.ly/flagship19. Apologies for those that are joining on the phone that don't see the slides, but you'll find it at transformfinance.org as well. In terms of investor network updates, we'll have a webinar on July 24th with our friends and colleagues from MC Social Capital. Catherine Covington will be joining us to present their guarantee model. And then we'll have August and September, two exciting discussions. One around the Catalytic Capital Consortium and how we see it as fitting with our approach around the how, not the what, with the Rockefeller Foundation and MacArthur Foundation, and a bit of an experimental session with our friends at Impact Alpha, where we'll pick 10 random current events in the field of impact investing and social finance, and go back and forth, hopefully with some disagreement on what they mean for the field. So stay tuned for those, and as always, please do share your topics with us if you have ideas for what you'd like us to cover with you. That's it from my end for now. So today's topic, again, is the idea of using capital to create shared wealth. and getting very concrete with the idea of a private equity fund model for employee ownership conversions in a succession context. I'm sure there is something that rolls off the tongue a little bit easier, but that actually tells you what it is that we'll be talking about. And with that, I will turn it over to Scott Abrams from Open Society Foundations from their Economic Justice Program.
Thanks. Andrea, can you hear me? Okay, very good. Hi, everybody. Thank you, Andrea, and the entire Transform Finance team for having me on today. I'm Scott Abrams. I'm with the Open Society Foundations. And today I'm sort of stepping into the big shoes of Robin Varghese, who many of you may know, who's led this work from our side and is traveling presently. But I will try to do my best. Andrea asked me to offer a few framing remarks sort of to set the stage for today's conversation. And so I will embark on that presently. As Andrea mentioned, I'm with the Economic Justice Program, which is a new program at the Foundations. We're in fact so new that we don't even have much of a web presence, nor even a defined sort of mission statement. That's all a work in progress right now. But what I think is interesting is that even though we're so new, essentially we are one of the largest, if not the largest program at the Foundation, with about $100 million or so of annual grants and impact investment capital to deploy. And why that's interesting from sort of at least an internal perspective is that for a foundation that for nearly 30 years kind of eschewed working on economic issues, focusing exclusively on civic and political rights, this has been a profound fundamental shift. And it's a reflection, of course, about the times in which we live and all that's kind of gone wrong with the mainstream assumptions that I think underpinned neoliberal economics for the last more or less generation. So what sort of drew us to supporting this work of Transform Finance that we'll be discussing today? As their name would imply, of course, Transform Finance has been designing and exploring investment models seeking to mobilize capital and transformative social change for quite some time. And one piece of this is deploying capital at scale, which is probably the key thing we're going to talk about today, to accelerate employee ownership. And it's sort of our mutual effort, our combined effort, to see how creative finance can help advance solutions and not manufacture problems, as has so often been the case. And I think that's the reason why we're all drawn to these calls that Andrea and the team organize regularly. The Economic Justice Program isn't an economic development agency in the traditional sense. There are myriad kind of other actors working on growth strategies, employment generation, things of that nature. Not really us. We're a political philanthropy, some of you may have heard. And so we're fundamentally interested in the intersect between the economy and the socio-political side. As in sort of, we think about ways in which the economy is structured or managed, or how participatory it is or not, how it serves or fails the more vulnerable segments of society, and how do these things impact broader society and democracy writ large. So these questions dovetail, I think, completely, if I'm not mistaken, with Transform Finance's mantra of always probing the question, whether through their work they're redefining who wins and loses through the investments that they approach. As a program, our work is primarily in the Global South, but the impact of the economy on democratic practice in the U.S. and the UK, where we've so far focused our work on shared ownership, has more or less compelled us to start building out a raft of work in these two countries, because essentially, we certainly don't believe in trickle-down economics, but we do believe in influencer nations, and that if we can pioneer innovations in places like the U.S. and the UK to advance a more democratic form of economy, then we're hopeful that we can have a spillover impact. And the fund structures basically championed by Transform Finance today that we'll discuss are examples of that. I would say that sort of the ever-skewing of power is our central concern. We know that power begets more influence, which in turn begets more power, and this is the uninterrupted cycle we've been trapped in for decades. And amazingly, even the 2009 financial crisis didn't break that cycle. I'm not sure what would, in fact. But the fact that sort of the skewing of economic power has become ever more pronounced since then is of great concern. And power, alas, has a lot to do with ownership. So what we also see is that the growing concentration of corporate power is impacting everything from competition to pricing to safety to policy setting to elections, you name it. And the increasing worker vulnerability and the lack of voice and precarity have resulted really in an underclass with minimal economic security. We see a severe public health crisis as a result, or at least in part, and a whole host of economic externalities which the rest of society ends up paying the price for one way or another when you have underpaid workers dependent on welfare or Medicaid, gig economy workers who can't access benefits. So many issues bring us to this conversation. And, you know, then we start to ask, what could some of the practical responses to these challenges be? And, you know, promoting shared ownership, cooperatives, ESOPs, trusts, etc., have all gotten us animated for a number of reasons. The first, of course, is timing. We're sort of at the cusp or in the throes of a once-in-a-lifetime moment, really, with the silver tsunami or the baby boomer retirement, this trillion-dollar moment, as it were, of assets needing somewhere to go in communities across not only the US and the UK, but we're hearing the same story coming out of South Africa and other parts of the world as well. Where will all of these assets go? And we see shared ownership as one potential or at least partial solution to that. And the second big category of sort of area that gets us really animated is the potential impact. And we see four big opportunities that straddle economics and political society. The first is that shared ownership is a form of pre-distribution, and in today's political climate, we see that as being far more feasible or palatable than redistribution in many senses. The second is that we know from other parts of the world, for example, Mondragon in Spain or Emilia-Romagna in Italy, that shared ownership can and has produced far more equitably distributed gains and more resilient businesses at reasonable scale. This isn't national scale. This isn't even necessarily sectoral scale, but it's some degree of scale that's impressive. So we know there's a far way we can go in other parts of the world. Third is that participation in firm-level decision-making leads to heightened public participation beyond the workplace. In elections and school boards and community engagement, we've for a long time had anecdotal evidence of this and just amazing stories that we've heard. But increasingly, we're also getting more rigorous data that proves this out as well. And Joe Blasi, who I'm sure most of you know at Rutgers, is helping to mentor a paper that's coming out very soon that looks squarely at this question and offers some really compelling data to back up this claim. And that's sort of why the focus, I think, for this conversation that we'll have today is around democratic employee ownership and not traditional ESOPs per se only. Fourth, shared ownership forms are highly inclusive in many ways. I was recently, as I'm sure many of you have looked into, I was recently visiting the Evergreen Cooperatives in Ohio, and what we saw there is second chancers, people who were formerly incarcerated, being given ownership stakes in reasonably large-sized companies and dropping effectively the recidivism rate to zero. When you're an owner of a company, you have a totally different set of opportunities and perspectives. And if folks are looking for ways in which to tackle various social problems, we see shared ownership as a very compelling avenue for that. Now, notwithstanding Mondragon and Emilia-Romagna, scale, of course, remains sort of the beast of barriers to surmount. So the work that we'll discuss today, in many ways, is us not trying to pick a winning model per se, but rather trying to start a race for lots of different models, which we can hopefully find ways to all experiment with and therefore test out what might work in terms of scaling behavior. We certainly know there aren't likely to be any silver bullets or perfect solutions, but we're hoping that some of the models that Transform Finance will highlight today will help to shift some thinking and practice and advance new ways in which we could look at this question. And perhaps we'll even be able to shift the acronym from PE, private equity, over to something like public-minded equity, not needing to change any of the letters, but changing the fundamental value and meaning behind that very acronym. So let me leave it at that in terms of the framing. and turn it back over and say how excited I am for this conversation. Yes. So there's a question about what we're doing in the UK, which I will start to answer, and hopefully Camilla will interrupt me when the audio works over there. So we have a multi-pronged strategy that looks at both the US and the UK in more or less the same way, and that involves looking for places to place our investment capital with CDFIs and other institutions to work on conversions and startups, and at the same time to work on some place-based work. Many of you may have heard about the Preston model in the UK, the glorious city of Preston, which is reorienting its sort of entire economy around a very democratically oriented principles. And so we're backing some place-based work, looking for a second part of the UK to do additional place-based work while we do the investment work. And the third sort of main cone of activity is around awareness raising. Given that we're still finding across both economies of sort of a paucity of awareness from retiring business owners, business brokers, small business agencies, that this is even an option. And until we feel, is the sound better now?
And also, Scott, I should be back now.
Oh, okay, good.
Can you hear me?
Filling space. Please, go ahead.
Well, you were doing a fabulous job, but let me jump in just to follow the order now. Apologies, everyone. I don't know. There's always something, even after webinar number 58. There's always some issue. Anyways, here we are. I was saying Camille and I started this conversation probably around 2014, 2015. So I'm really glad to see it coming to fruition now. And it's still not a finished piece of work to us. So we issued this now as a working paper because we thought that even after talking with probably 30 or 40 practitioners or so and bringing in all the years of experience of Camille in the space, there's still a lot more to be done. So please do send us your comments. Sooner the better, so we can actually get them in there. Andrea at Transform Finance, Camille at Transform Finance, info at Transform Finance, just send them and somebody will get them. So we do look to your active participation, and with your registration link, you should have gotten also access to a copy of the working paper. Now, I want to run quickly through this so that I can pass it over to Camille for some of the meat of the model itself. As we always do, contextualizing the session within the broader work of Transform Finance. In the context of the Transform Finance principles, when we look at governance and ownership, right, employee ownership really has always stood out as one of the opportunities to create asset building, not just for those that already own the capital, but for those that have given the labor to productivity. And in particular, we have been looking at this from the context of the racial wealth gap and the extraction of wealth from communities of color and from low-income workers. So we'll be very upfront with this, right? This is not what we're talking about is not a play to use private equity to juice returns. This is really a repurposing of private equity as simply as a financing mechanism in order to create this more distributed wealth. And that's why we see this fitting with the second principle of non-extractiveness, right, of creating more value than what goes out as a reward to the providers of the financing. We have seen historically, as you're all aware, instances where employee ownership in the ESOP structure back in the day could be abused at the expense of employees with over-leveraging of companies and undue valuations and the like. And so that ends up hitting the third Transform Finance principle in terms of the fair allocation of risks and returns among stakeholders, so that the workers who are generally in the weakest position of power vis-a-vis capital are not unduly put at risk. Now, in the context of successors, which is this moment that Scott was alluding to in terms of the silver tsunami, the retirement of the baby boomers. We start from the hypothesis that is validated by the field that there are a lot of retiring business owners that would be interested in doing employee ownership as their exit. Maybe because there are no other options, maybe because traditional private equity is not interested or there is no strategic acquirer. And by doing so, they can get their exit, they can get their liquidity without negatively affecting the workers. The jobs stay where they are, the legacy continues, and in fact, those jobs improve because of the correlation that there is that is documented between employee ownership and higher quality jobs. So these are anchored locally. If you look at this from a geographic perspective of some of the communities that are already economically marginalized, the last thing you want to do is lose more and more of those jobs through the retirement of the current owners. So there is a place-based element to this. And this might be more controversial, so I really mean it in that way, as Scott was saying, of starting a race, not picking winners. There is something to be said for an ongoing business that is chugging along, even though it's not so interesting, perhaps, to those that would want to look at private equity levels of returns traditionally, right? So there is less of that startup risk by doing this type of conversions of more mature companies compared to starting companies in an employee ownership form. Now, from the investor perspective, which is the core of this community in some ways, this ties into our usual obsession with looking at the looking at the how of an investment rather than the what in terms of what the product and service is. As you will see, by and large, we're not talking about, industries that produce recycled yoga mats or coconut juice or anything like that. We're fairly agnostic as to the product that is being created. What we care about is the how. How is the company governed? Who benefits from it? Who has voice, who obtains power. So very much a way of investing with a how thesis rather than a what thesis. For many investors that ostensibly care about workers, job creation, ideally quality job creation, this is an opportunity to really tie directly to the benefit for marginalized workers. Excuse me. And this is also a little bit at the margins, perhaps, of the general conversation in employee ownership. We think that this is both a way of distributing access to wealth-building opportunities to capital, but also to proactively, as our friends at Social Capital in Toronto say, think of it as a way of competing head-to-head with traditional private equity because of the negative effect on the economy in general that private equity has had in terms of extraction and in terms of consolidation of industries and general disregard for workers. That's a big blanket statement, but might as well put it out there in this crowd, and then you can qualify it as you wish. So with that as a context for why Transform Finance has been excited to look at alternative ownership, investment in alternative ownerships, and within that, investment in employee ownership conversions, I will turn it over to Camille to walk us through it. So thank you so much, Camille. I will unmute you. There you go.
Can you hear me?
And I'll turn you the slides. Yes.
Okay, yay. All right. Thanks for bearing with us on those technical difficulties. So first thing, I'm going to echo a little bit of what Scott said about why we're focusing on employee ownership as an area to really scale economic impact and address economic inequality. One, in the employee ownership space, we see not just smaller firms that won't make a difference in the larger economic scope of our countries, but really big companies. The largest employee-owned company is 190,000 employees, and they're majority employee-owned. We've seen that this not only can be in larger firms, but that it can replicate in a lot of different businesses as well. We see over 3,500 majority employee-owned companies employing over 1 million employees in a wide range of businesses. So that's really exciting to see that kind of both depth and breadth. And then we also see the wealth building potential, and there's some new research out on this from Rutgers that there's wealth building potential that reduces the racial wealth gap specifically, although there are some caveats to that because, some groups, particularly African American women, don't fare as well as other groups, but we have seen in general that it is making it so people who otherwise would only have, a couple $100 in assets have tens, if not hundreds of thousands, which is a major shift. And right now we're in a couple different exciting moments in the field. There's momentum, policy momentum, an uptick in interest from both philanthropy and policymakers, and a new focus on how exactly this form can be used to address economic inequality, not just be a useful transition tool for business owners, but how it can be directly used to address the most pressing issues that our economy is facing today, including the racial wealth gap and income inequality more generally. So we're excited to see that happening throughout the field, this refocus. And I'm just only going to briefly touch on this moment issue, as a lot of it's been discussed already, but the silver tsunami, as both Scott and Andrea mentioned, is one of the reasons that so many organizations are like, we need to move right now, have that urgency, have that excitement about making sure that this forum feels available to a larger group of owners, because right now baby boomers who are in the process of retiring, although one of the reasons the tsunami didn't hit as hard right at the beginning is people are staying on. This is their businesses are part of their purpose. So we're seeing people really linger in their businesses where they might have retired before at 60 or 62. Now it's 68, 72, 76, and people are starting to call like, I'm 76. I should start thinking about this. So that's part of what we're seeing right now. But we have at least another decade and a half or so of people moving out of these businesses. Like I said, with policy momentum, the Main Street Employee Ownership Act, the most significant legislation that we've seen on employee ownership in 20 years, just passed this year with bipartisan support, or this past year in 2018 with bipartisan support. And I mean, we just saw a new ordinance funding worker cooperative development in Berkeley just a couple weeks ago that passed. We're seeing it nationwide, more and more local and state initiatives to support employee ownership as well. And we've also seen, like Andrea was saying, we've had this idea, a lot of us in the field have had this idea, what if we had this fund for this fund that could help take businesses and convert them to worker ownership for a long time, but in this moment, this was the moment that we really need to do this work, because investors are going from, hey, that's an interesting idea, to where do I put my money? What are the vehicles that I can use to invest in employee ownership? And so we wanted to make sure that we could highlight those and make them available to investors. So a couple things that I'm going to go over, and feel free to just throw things at the chat. I'll glance over at them along the way if you have questions along the way. We're going to talk a little bit about very briefly about just how conversions, how worker ownership works. Some different contexts that are opportunities to invest in it right now, and then this idea that we're trying to put out there, what if we had a dedicated fund model and how that would work in the different pathways to getting there. So that's kind of the arc of what I'm going to be going over in the next little while, and please chime in if you have questions along the way. So first thing is the mechanics of conversion. So what does it mean to go from being conventionally owned to being a worker-owned company? So basically, either the company redeems or the shareholders sell directly to the new worker owners. But basically, you're just moving stock from existing shareholders, which might be a handful of founders, or it might include some family and friends investors, or even institutional investors. You take that money, you purchase usually at market, maybe slightly below market, purchase those shares, and then workers and then it's transferred to workers. And that can be through direct share plans where workers buy or are gifted a share directly, or through a trust that holds the shares on behalf of employees. We're not going to go really in depth in these different mechanisms today, but if you want to reach out to me directly, I'm happy to talk to you, and the paper itself has some information about the different forms. So just to note, because there's always a little bit of confusion about this idea, the employees are not paying for the full value of the firm. A lot of people are like, well, employee ownership might make sense for some people, but my employees can't buy a business, or employees in that company can't buy the business. In many cases, the workers are not paying for any percentage of the firm with their own capital. It's 100% leveraged, or the company is gifting some of that. Where the workers are paying, like in the context of a worker cooperative or a direct share plan, it's usually a small percentage of the overall value of the company, say like 10% if there's a 100% transaction, something like that. And just lastly, right now, what mostly happens is that the sellers generally are financing a large percentage of it. In many cases, both in the worker co-op space and in the ESOP space, sellers finance a majority of the transaction. And maybe lenders will come in, there will be senior debt as well that's available. But in many cases, the sellers are the ones who are financing the transaction. So we want to think about how can money come into this space and act as a catalyst to make more employee ownership for all the reasons that Scott talked about, that Andrea talked about how employee ownership can address both economic issues and civic engagement. How can we use money as a catalyst to make more of these transactions happen? And one of the ways that we can do that is, like I mentioned, sellers bear a lot of the risk and don't get liquidity in a lot of cases with employee ownership transactions because they are financing the transaction themselves. So if we bring money in, if we bring financing options in, that means the owners have more liquidity. They're taking on shorter term and lower levels of reinvestment, which they can use to go and be retired, especially when you're talking about people who only do have they're 75 and they want to enjoy those last 2 years of retirement. They want liquidity with that money. And for many right now, the only option for financing might be, I just heard an echo. The only option for financing would be financing it themselves. And then having outside capital is the driving force behind new conversions. One of the complaints we hear in the employee owner, not complaints, but one of the reasons that we hear in the employee ownership field often for why more businesses don't think about this option is because their current advisors don't have any reason to suggest it to them. They don't have any reason to say like, hey, an employee ownership as an option would make sense for you. But as a capital partner, as a fund could come as a capital partner and suggest this and have an incentive to say why employee ownership would be a good fit for them, whereas your accountant who might not know how to work with an employee-owned company but knew how to work with your company before that doesn't have that same incentive. So briefly, let's talk about the field and the status of employee ownership investing as it is. And this is drawing off of work that others done, that Marianne Beister and Marjorie Kelly and others have done, looking at where there is financing, where there is investment employee ownership right now. And they basically saw two major opportunities when they did this, and when we updated that research, we saw the same, which is you can invest in a CDFI, a community development finance institution that focuses on cooperatives or employee ownership specifically. You could invest in a private equity group that uses the ESOP model, and there's a handful of them out there. None of them only use the ESOP model, but there are multiple of them that have used it as a tool in their toolbox, which we'll discuss a little bit more. Or you could put your money directly into a transaction. You could, partner with a senior lender, for instance, and provide mezzanine debt as a small family office or some other way you can directly finance a transition to employee ownership. So first, before we look into, what kind of gaps that those options leave and what other options we want to put on the table, wanted to walk you through kind of what these structures look like. And I know this is a little bit of a complex chart, but wanted to help you be grounded in what the role of finance is in these different, in these transactions. So if you can follow me along here, and I'll try to speak through it too for those of you who are just on the phone. So when what we're looking at right now is a private equity plus ESOP transaction structure. So this is the case where it's not just a seller who who's self-financing the transaction or just has senior debt, but the case where a private equity group is coming in, providing financing and liquidity to the owner for this transaction. And this is kind of this idea that we're trying to replicate here, right, where a finance institution can inject capital to provide more liquidity and make this a more attractive option for selling owners. So in this case, you'd have a selling shareholder, one or more selling shareholders. They would sell their shares back to the company, and that would be financed by a combination of their own reinvestment, but that's a smaller amount. It might be like 40% or more, or up to 70% in a traditional transaction. In this case, the seller reinvestment is a lot lower, like 20%. The private equity fund would come in with mezzanine debt, and which is junior debt, so it's not collateralized the same way that senior debt, regular loan debt, is collateralized, and then a senior lender would come in as well. And together, these three parties would fund the 100% liquidity of the selling shareholder, although the selling shareholder would then reinvest 20% of that. And then the company would sell those shares to the trust in exchange for an internal loan. And then, so 100% of the stock in this case would be in that trust. But the seller warrants and the private equity fund warrants, and I can describe what a warrant is, would provide returns and upside for both of them as investors. Now, what a warrant is basically a stock option, but it's for, instead of like a compensation for an employee in an early stage startup, it's for these investors and these selling owners, and it basically gives them the right to purchase shares at a certain price. So that's like at maybe current value, so that they can capture some of the upside of the company as it continues to grow. So that's one of the ways that investment currently interacts with employee ownership, is this private equity fund role. Like you as an investor might put money into a private equity fund that would facilitate these types of transactions happening. And just a visual so you can see what a financing structure, if we're talking about, and this is from Ira Starr's article that he wrote on private equity and ESOPs, a creative combination. But you're seeing here kind of a little bit of the breakdown of the terms and amounts that the senior debt versus the private equity versus the seller would provide. And so, the terms for senior debt might be 5%, whereas the notes are 10 to 12 and 25% of diluted equity value. Now, on the other hand, on the other side of the scale, and you'll see very drastic numbers, and this is representative of what we're seeing in the field. ESOP transactions range from the high end of Main Street firms to like all the way through middle market firms. So it's larger firms that we have. Whereas in worker cooperatives, we're not seeing very many. It's definitely the outlier to see something that's more than $2 or $3 million, and most of them are in the $500,000 type range. So here's a example of how financing in a worker cooperative structure might work. And in this case, from the investor perspective, you would be coming in by providing, you would be investing in a CDFI that would provide the senior debt, the line of credit, and other financing in this case. So here we see a chart where the total sources and uses is $900,000 for the transaction, where the senior debt ranges from 4 to 7%, and the line of credit is similarly 6 to 8%. And the seller has kind of somewhere between senior debt and mezzanine levels of return at 4 to 10%. So that's a little bit of just to show you the kind of stark difference between what exists in the ESOP field and the worker cooperative field. And I think I have a question here. The main thing I worry about is over-leveraging the company. Are there rules of thumb about size of business, margin structure, et cetera, that would be useful to consider? Yes, absolutely. So over-leveraging is something that so first thing, ESOPs from a regulatory basis cannot be sold for more than their market value. That's something that the DOL is very strict about, and that they will go after companies who have any who vary from that or try to get too much value out to the owners. And so valuation firms, the trustees are on the hook. There are fiduciaries on the hook if a company is overvalued. That doesn't mean they necessarily have the cash flow to pay back their debt, and that's another question that you have to be very careful about, is making sure the financial planning makes sense, not just is it the right amount for the company, but is it sustainable for the company to take on that debt and continue to thrive with this newly highly leveraged state. And in many cases, for ESOPs in particular, and the reason that ESOPs have thrived, one of the reasons that ESOPs have thrived so much is that the tax advantages of an ESOP, like 100% S corporation ESOP, pays no federal or in many cases state income taxes whatsoever. So they have the same tax profile as a 501c3 nonprofit, except you can't donate to them. So they don't pay any taxes back, so that offsets the leverage that they have to pay, and the company continues to thrive. But that's not always the case. If they have a down year, they're still paying for the leverage, but they're not getting those tax benefits, for instance, stuff like that. So it can be an issue, and that's something that, financial planning in the process of determining whether employee ownership is a good option is really critical. I'm going to keep going and then get to this next question soon. So some of the reasons that we are thinking about particularly adding to this ecosystem a dedicated impact-oriented fund are here on this slide. So like we said, there are a couple options right now for financing employee ownership, including investing in CDFIs that help finance these deals, and investing in private equity groups that finance these deals. But we think that one, both of those areas could expand, and two, there's room for more entrants that are specifically dedicated to employee ownership, not just to employee ownership conversions. There's enough of a market to just focus on these types of conversions and thrive as an investment institution. So one of the reasons we're excited about this is, like we said, capital can unlock potential by giving more liquidity to owners and give investors a space to look. So right now, some of the CDFIs they have an investment profile where it's often a bond type or a CD type investment option, or a target dividend in the 3 to something % range, which is a really good option for some investors. Other investors are looking for slightly more aggressive returns than 3, 4, 5, or 6%, which are more akin to debt returns. So can we find the intersection of the types of values that CDFIs and others have in addressing income inequality and returns that they don't need to be the same as existing private equity firms, but maybe above debt, higher than debt levels? Can we unlock that space? We also think that this approach is replicable in that it's a familiar model. Private equity leverage or leverage buyout funds in general is a familiar model, and if we can work, if we can help demonstrate that this model works with employee ownership specifically, then it can, through the market, replicate itself. And we think that, one of the things that we've seen in the employee ownership space specifically is that worker ownership is way more effective as a tool to build wealth and drive company performance if there's a culture of ownership. And by having a investor who's very involved in the process of a company becoming employee-owned, it can set the tone that culture is really critical and build that into it. And as Andrea will talk about later, we're also looking at determining, setting out guidelines for impact, baking that into a fund from the get-go so that the companies that you're working with have, they have the finance institution itself, the mission-aligned finance institution itself is making sure that the company is operating in a way that benefits workers. So I'm going to pause there for a second. Are there PE firms working to do this type of financing already, or is it a skill interest they would need to develop? Any concerns about the incentives structuring with PE involved in something built to create sustainable impact on employees, not just financial upside or exit? So yes, there are private equity groups that are doing this type of financing already. Mosaic Capital, Long Point Capital, American Working Capital, Endeavor Capital, I think, has done one as well. So there are a handful that have done this. None of them are dedicated to only doing this type of transaction. They each have added ESOPs into their portfolio for when it makes the most sense for tax or other reasons for their owners to do so. And I'm going to just keep moving and we'll get back to some of these questions. So what are the pathways? And Andrea, feel free to cut me off or say I'm going too long on things anytime, okay? So what are the pathways to building this type of fund? So there's a couple different approaches. One would be to, as either an investor, an asset manager of some sort, or a fund manager, to go about establishing a bespoke fund that's on employee ownership specifically, that uses the mechanism of buying businesses and transitioning them to employee ownership to get liquidity, or to provide returns for your LPs, for your investors. So you could build this new bespoke fund. Some of the plus sides of that is, you have full control over what that fund does, what its impact is, what its approach is, what kind of companies that it takes on as either the asset manager or the general manager or whatever role that you're coming in to start this fund at. The downside is, you have to raise the money, and you have to, and this will be a first time concept for you because nobody's coming into the field having run, or they could. Some of the people at Mosaic might be able to, but nobody's coming in having run a fund that's dedicated solely to employee ownership before. So when you come in, you're starting something new, and that's always harder to sell than something that's been proven out before. Another way to this fund is, as an asset manager, is to catalyze some of the early stage employee ownership funds that are happening right now. We'll look at who those are, but that each of them is currently raising or about to raise, and they already have employee ownership. Each one of them is interested solely in employee ownership, and they're looking to do that initial raise. And the other one is kind of a pathway to this dedicated fund, which is just assembling a special purpose vehicle for a single transaction as a precursor to a fund to prove out to demonstrate the possibility for that same business model, that same financing model to replicate through a fund. Just build a special purpose vehicle to do a specific transaction, and then hopefully roll that into a fund. Great. I see a couple of questions. One of them is, Sarah mentioning that KKR has done a few. So they haven't done majority employee ownership, which is what we're suggesting here. What they have done is share the upside of their ownership by providing equity compensation to a broad range of employees, including, based on tenure, not based on being a manager or other things like that. And I'm going to just wait because it's going to take me a little bit of time to process what these questions are. So, if, Andrea, if you want to read through them and think about the answers a little bit more, I'm going to just keep moving. So when we're talking about starting a new dedicated fund, we want to think about what size are we talking about. And this map, although it does kind of in some ways convolute like lending, finance institutions, and actual private equity funds, we wanted to give you a little bit of we want to give you a visual on the landscape for employee ownership, financing, and investment opportunities right now. And to give context of like, okay, if we're starting a new fund, what size should it be? So right now, when you're looking at the employee ownership and cooperative-focused CDFIs, you're seeing, many of them are under 10 million in assets, and certainly under 10 million in annually deployed capital. And there's a couple that are in the $10 to $30 million range in terms of asset and/or deployed capital. And I don't think you can really see on this chart, but the red y-axis is basically at the bottom is fully grant subsidized. We see some of these CDFIs are subsidized, like up to 70% of their operations are subsidized, whereas as you get up to the larger CDFIs and Capital Impact Partners does do some employee ownership, worker cooperative conversion work now, or is getting into it, and they're on the larger size of deploying, closer to 100 million per year, and they work at 80% efficiency, whereas some of the smaller ones work at 30% efficiency. So we're seeing this this range of subsidy, and then on the other side is returns, where some of the smaller funds you're getting very subsidized returns, whereas when you're looking at the PE plus ESOP funds, they're advertising market rate private equity returns as part of their fund, and I think achieving them in many cases. They have clients that are like state pension funds and other clients that are looking for market rate returns for their institutional clients. So we don't see anything right now at this moment in this range, in this very large range, small circle, but a large range of $30 million to $150 million. We're not seeing a lot of active funds that are lending in that space. So that's just something that we want to, the context that we want to be aware of. So size, so when we're thinking about building a new fund or looking at the funds that are being built, so of both a bespoke fund or the funds that are in existence right now, there's a couple different approaches that you could take that they are taking. One of them is basically doing the private equity plus ESOP model. And using what they're doing right now. So those companies are often doing 9 to 11 deals where, it's $15 million of their own capital, and then they leverage outside capital to do the deals. And that's kind of the size of the fund is in the $150 to $250 million range. The deal size for their capital is about $15 million, and they're doing 10 deals during the fund. That's kind of, so you could replicate that, but only do employee ownership and have some of these impact guardrails. That's one of the options. Another option is to build the fund in a missing range, and the reason that we might focus on that missing range is that's the range that a lot of social impact funds tend to get started in. Like, it's hard to start an impact-oriented fund on the range starting at over $100 million, starting in $150 and $250 million range, especially when it's a first-time concept. So what if we think about building a fund in this missing range where We have seen examples of private equity live in that range. It's not the most common range, like a $50 million, let's say a $50 million private equity fund. They do exist. They don't get the same returns as the larger ones. They don't have the same time horizons as the larger ones, but they do exist, and they do exist in the market independently. So we could build a fund in that range to start leveraging up to a larger fund. And then the other option, which Andrea has been exploring with social capital partners and others, is can we kind of blow it out of the water a little bit more, do a KKR-sized deal that's actually like majority employee owned on the other side, to demonstrate to people that this is a real option for competing with private equity. So really look at that larger end of middle market and try to demonstrate either through starting with just a single deal, a special purpose vehicle, or a pledge fund, but really having that kind of larger deal blow it out of the water. So I want to go through and highlight, it's a little bit fuzzy on the screen, but I think you can read it, highlight some of the organizations that are thinking about employee ownership or that are starting employee ownership specific funds right now. One of them by my good friend Chris Mackin, who I believe might be on the call today, is the Inclusive Capitalism Fund, which is mirroring the kind of approach that that Mosaic and Longpoint and others in this field, in the private equity group and PE+ESOP field have had, but focusing specifically on employee ownership and with the mission of, like Scott said, pre-distribution of wealth, right? Like that was their mission. That's the written mission of the organization, unlike some of these other private equity groups that use employee ownership, in which case they're there to get returns for their investors, and employee ownership is a good option. The Inclusive Capital Fund is about building wealth and spreading it, pre-distributing it, and spreading it more widely. Another one that's on here is the Fund for Employee Ownership. Another one of my friends who's I think also on the call here, Jess, and they it says raised 5, but I believe it's significantly more than that now. Funds to their fund is taking businesses specifically in the Cleveland metropolitan area and converting them to worker ownership, democratic worker ownership, as part of the network of evergreen cooperatives that they've already built. So they're leveraging the business expertise and the resources that Evergreen has already established, and then using that network of support to start a new fund that would identify businesses and provide the financing to switch them to employee ownership and bring them into that network. And as Scott mentioned, their work has a deep low-wage worker and racial equity impact focus. A large percentage of the workers at their laundry and other firms are formerly incarcerated, and there's a significant number, I think it's like 95% are people of color. Another example is that this is kind of an interesting thing, is, in between when Andrea and I and others started thinking about this idea and when we started writing this paper, new funds that are thinking about this idea have popped up, like Middlebridge Capital. They were also thinking about this, PE+ESOP model, raising in that same range, and focusing specifically on employee ownership. So similar to American Working Capital, it says here that they have a member of the core team as a worker ownership expert. I'm not sure that that's still true, but but they are employee ownership specific in their focus. And then we're going to go through a couple of more. So we're really excited to see the engagement of the social investing field in this employee ownership world. It's funny, some of us come from like the impact investing world who've been working on this. Some of us come from the employee ownership world, and it's great to see interest from the employee ownership world and having more impact lens in their funds, and then from the impact world and using employee ownership. And this is the example of the latter with the Community Development Venture Capital Alliance, CDVCA. exploring the creation of a national worker ownership impact fund, they would be thinking, just like other new impact vehicles, in the $50 million gap range, as we've been calling it, and that they will bring their deep knowledge of impact investing and then bring in employee ownership expertise on top of that. Another fund that I'm really excited about, it's very nascent in its phase, but it's very exciting, is the Legacy Business Fund, the Democracy at Work Institute, and in particular, my colleague there, Todd Leverett, is working with his contacts in the finance world to start a fund that would specifically target minority-owned businesses. So, for instance, so they're in the D.C. area, and a lot of minority-owned businesses have state contracts for construction or other things like that, and some of their owners are getting older. So they're looking at targeting specifically those firms that are currently minority-owned and making sure that they stay in the hands of people of color as they transition and continue to be able to provide those services, those contracts, those services to the government and other clients. So I think they're early stage in their development, but they have a management team and a thesis, and they're developing out their market research right now. And then, of course, the working world is also targeting in that gap range of $50 million. They have $9 million deployed right now, and they have a lot of experience already, having done worker cooperative conversions using financing, both that is like lending and that is equity to facilitate the transaction. And they are, very mission oriented and provide for their work is about addressing income inequality and the racial wealth gap as well. Okay. So I wanted just to briefly talk about what are some other ways that capital can be a catalyst that we're not covering as much. We're focused on in this paper and in this webinar about the idea, what would it be like to have an employee ownership specific fund that was scalable. But there's other options for capital injecting itself in order to create more employee ownership. One of those is adding employee ownership to existing portfolios. So impact investing portfolios, if you have investments right now and you're like, I don't know if that liquidity event that I expected to happen is going to happen. Maybe we should look at other alternatives for exiting our investment, and maybe employee ownership should be on that list. Also just, partnering with existing employee ownership, worker cooperative, technical assistance providers and consultants to identify opportunities of transactions that need capital and coming in and financing those deals directly. Another idea is we kind of focused on the PE+ESOP closed-end fund idea is what we think might make the most sense for scale and replicability and market return, or closer to market returns. But there's also, you could do pledge funds or search funds, which are instead of having to raise $150 million beforehand, you have a number of investors who have the option to participate in any given deal, and you find opportunities for investment that's more one-off than full-on investing in a fund for the 7 to 10 year time period. And then, of course, we encourage you always to support worker ownership CDFIs and continue the great work that they do providing gap capital for financing conversion. So we're talking about, like I said, the working world, but also Shared Capital Cooperative, the Local Enterprise Assistance Fund, the Cooperative Fund of New England, all of these organizations, and then, the Ohio Employee Ownership Center has a fund, as does the Vermont Employee Ownership Center. These funds have been supporting converting businesses for a very long time, and their gap capital makes conversions, many worker cooperative conversions possible that otherwise would not be. And Andrea, do I want to pass it back off to you with this slide here?
Yeah, thank you, Camille, and we'll give you, if nothing else, a little bit of a breather there. So thanks for walking us through all of that. I mean, there is a lot here that we can try to unpack. So I wanted to address a few of the elements of workplace democracy and impact guardrails that we have been thinking about, in part because they go also to the questions that have been coming up around the returns, around some of the alternative structures that are out there. So let's think of it as a bit of a Venn diagram that starts from millions and millions of businesses are changing hands. Some of them will die. Some of them will be left alone, etc. Okay, so there is a broad pipeline there. It's true that some of them will be potentially financed by the sellers themselves, right, with the seller note. Other ones, there will be competition for some sort of like mezz debt financing for as against what the seller could provide or what a traditional PE+ESOP could provide. But we're positing that if that pipeline is so large, there must be some where the but-for factor is this lack of outside mezz debt type of capital that can make the transaction happen. And that we can do that in accordance with the impact thesis that led us into this work in the first place, right? We, or at least as far as I'm concerned, and probably Camille as well, we don't come at this from a love of private equity per se. It's an effort at being somewhat creative at how is it that we can center some of the things that we care about, such as worker voice, worker powers, and workplace democracy, and the impact on historically marginalized workers in a way that does not perpetuate investor primacy because the investors are the ones that are leading on the transaction, right? We would like to see the investors as the facilitators of a worker-centric transaction, as we've been calling it. Now, there are a few questions as to workplace democracy, and again, I'm gonna run kind of roughshod over it, but worker co-ops on one end are the ultimate manifestation of workplace democracy. However, they are a small universe in the United States, not like in Italy where I grew up, where they are a major economic force, as Scott was referenced in the case of Emilia-Romagna, for example. And then there are ESOPs that have nothing to do with workplace democracy, right? We are positing that there's an entire range in there. There are these democratically managed ESOPs. There are ESOP plus elements that we're thinking ought to be baked into each of these transactions. As Tom was bringing up in the chat, right, the creation of the culture of ownership, the creation of workplace democracy, the use of open book strategies are all things that need to be considered as part of this. And perhaps to pick up again on Scott's analogy of, this is starting a race, not picking a winner, I would hope that there is this broad variety of opportunities there, where there are some that are more towards the democratic end of things, others that are at a bigger scale, right? Probably there is a bit of a four-quadrant chart there as well of what can be done. But we're thinking that with the degree of attention that there is now, if the capital can be lined up in this way, where you have a smaller piece of seller financing, which makes it appealing for more sellers, where you have the senior debt available on reasonable non-extractive terms, and you have more of the what looks more like impact capital, frankly, doing the non-extractive mezz debt with the warrants, then you will be able to have some of the flexibility. Now, if you combine that flexibility, as Camille was saying, with the tax advantage of the 100% ESOP structure, then you should be able to reduce some of the pressure that there is on the returns and on the level of leverage for the workers. Essentially, this becomes a tax-free transaction under some constraints for the seller, right? So between selling to a private equity group, which is a fully taxed transaction, right, and being able to sell through this type of structure that would be largely tax-free, depending on how that money is reinvested, this might make it appealing for the selling share owner. For the selling owner that might actually also care about the worker democracy bits. Again, this doesn't mean it's for everyone, but if we're talking about a pipeline of potentially millions, we're seeing if this model could capture a large part of that and push it to towards the edge of workplace democracy. Now, why do I premise all that? Because there has been since the beginning this almost an ease from some of our peers and long-term friends and saying, wait a second, this is really likely to get co-opted by private equity. How is it possible to do this without having some serious guardrails in place? And that's where these sort of impact guardrails or characteristics come in. Again, we, in our usual way, are not looking for scale as an end in itself, right? We want to be able to scale something that actually works on the impact side. So we have put down a series of considerations that we have workshopped with many of you that we think are keep us true to the idea of really putting the private equity piece at the service of the workers. One of those pieces is actually locking in long-term employee ownership. The conversion piece can be done in a way that essentially is a financing gimmick, not necessarily an attempt at creating and locking in employee ownership. You want to have governance mechanisms around that. There are some diverging views on what the possibility should be for the workers themselves to choose to sell or not to sell after the conversion has happened that we can get into. We do want this to be focused on people of color and low-wage workers. There's been a lot of interesting activity in the employee ownership space around some of the higher margin, more like white-collar type of entities that, while they promote employee ownership generally, also tend to benefit people that already come from a significant amount of privilege. And we are looking here at companies where most of the benefit would go for low-wage workers. Now, going back to some of the questions that were coming up in the chat, that doesn't necessarily have an impact on the profitability profile of the company. If you want to do a conversion of this sort, where the profit margins might be lower, but where there is a tremendous positive impact on people of color and low-wage workers, well, you can do it. Somebody else has to take a bit of that hit, and it can be the LPs in the fund, or it can be, frankly, the GP in the fund as well, right? There is no reason why, from my perspective, the returns to the private equity capital provider should be the holy piece that doesn't get challenged. The justification that you often get for that is, well, you're not going to get to scale unless you make it really, really appealing for the PE piece. Again, maybe I'm still a little bit on the optimistic side, but I think that there will be private equity providers that can they're willing to say, yeah, let's distribute that value that is being created in a more fair way, where we're looking first and foremost at what the impact will be on the low-wage workers. Another important consideration here is the measurement of the impact on the workers. So what kind of jobs are being created, how much wealth is being created for these workers, are they quality jobs, And on some of the prior private equity ESOP transactions that we have seen, I haven't seen a deeper richness of measurement of the impact on the workers. And if we were to do this again, starting from a worker-centric perspective, it's quite fundamental that we measure it, that we manage it, and as you all will be tired of hearing from us, that the returns to the fund manager in terms of carry are actually tied to the achievement of a certain level of positive impact on the workers. So if you're saying that you're doing these transactions to create high-quality jobs for low-wage workers in marginalized communities, well, then your own compensation should be tied to that piece. I'm going to Tom's question from the chat also, right? The inclusion of the expertise of ownership culture in the team for the fund itself. The inclusion of some of the best practices around high road employment. Open book management is one of the recommendations that Camille put in the report as well. So there is a whole field, I would say, around proper creation of culture of ownership, really operationalizing this worker voice in a way that leads, in my, again, a bit dramatic view perhaps, to worker power that goes beyond just the workplace, but actually manifests in democracy more generally. And while we put it last, this idea of having non-extractive practices, right, of really being mindful of where the wealth is being created and who ultimately benefits from that. So having, even if it's not over-leveraged, as came out in one of the questions, is that good enough, or should we think about, what are some reasonable returns that the fund would have, and in order for that for the fund to improve its returns, what would have to give? Would it be a reduction in wages or benefits? Would it be decertification of a union? Again, over leveraging of the deal. If we are looking specifically at this idea of seeding a new fund, if I were to make, I don't know, a call for RFPs from fund managers, I would say, come to me with a fund concept that actually bakes in all these elements, and then let's look at what the pipeline is and what the returns will be to everyone. But first and foremost, it would be the parameters around the worker-centric impact, how that will be managed beyond the measurement, and how that will be reflected in the compensation for the fund manager itself. So those are, again, general guardrails that I would like to put out there, and I welcome responses to all of that. Now, before we get into some of the further explorations for the time that we have left, we can divvy up the questions however we would like. Camille, feel free to jump in on any of them. I could get us started with Delilah's question on where we refer to worker ownership-oriented PE fund competing with traditional PE. Is this fund making mezz debt or equity investment? And is it targeting mezz debt or PE-style equity returns? So that concept, Delilah, the idea of competing head-to-head with private equity is, as Camille pointed out, from our friends at Social Capital in Canada. I know that a couple of them might be on this call, so if one of them wants to address it here, you're welcome to unmute yourself and do so, or I can direct you to some of their materials offline or to their website. I don't want to speak on their behalf.
And in the meantime, just to highlight what Chris said on that issue, Chris Mackin from American Working Capital, is that the way that PE firms and the current PE firms that do employee ownership here in the U.S., they do often compete and win with private equity, with traditional private equity. They also identify as traditional private equity, so that's part of why. But with their ESOP deals, they've won deals from other private equity firms before. And like Chris said, they do kind of a MES plus profile in terms of their return profile. Another question that I saw here is, what can we learn from companies that have ESOP? Oh, go ahead.
Sorry, I see that John from Social Capital is there. So if you want to address this point around the competing with PE before we move on, you are unmuted. No, you're yeah.
I think you guys are dueling unmuting yourself, so maybe. There we go.
Okay, sorry, we can't hear you, John. See if you can figure that out while Camille goes on with the other questions. Sorry.
Great. So one of the other ones that I like is what can we learn from companies that have ESOPed? And a couple of them are listed. OGC is a very interesting example of that. One of the things that we want to kind of prevent from ESOPs is, people say that they're very vulnerable from being purchased because they have like a fiduciary requirement to be a retirement account, and so their trustee might have to take a multiple X deal. What we've seen in the field is that's not as much a risk. It doesn't really happen that often that an employee-owned company is bought against its management and board's will. What we do see, though, is management no longer being interested in the ESOP structure and slowly diluting it or getting rid of it over time. So that's something that we would want to learn, that we've learned from the field, is that the risk isn't really outside capital coming in and taking over companies against their will. The risk is internal. Management finding that they could get more money if they had a different structure than employee ownership, which shares it more broadly, and putting protections in that prevent that. OGC is its own, I think it's literally its own Transform Finance webinar. So, so I might defer on that one specifically, but that's definitely one of the lessons that we've learned on de-ESOPing. And it isn't the right structure for all organizations. If you are just profitable, then, it's hard to stay on top of repurchase obligations and other things like that. So the advisors would need, it needs to be in a company that's healthy and can manage all the financial obligations that come with being an ESOP. And of course the tax benefits offset that, but you still need to be a healthy company.
John, if you want to give it another shot, right? Sorry, we can still not hear you.
Oh, wow.
All right, Camille and Scott, of course, if you want to address some other points meanwhile, please go ahead.
I'm looking through.
That's
great. Go ahead, Andrea. I was just going to say it's really exciting because people are like, there's CFNE's represented, Leaf is represented, so it's great to see. I just want to say hi. Start.coop, I saw Greg Brodsky is also here. It's great to see all of you who are moving capital into this field and working to do that. So hi, everybody. But go ahead, Andrea.
No, I was just saying, yeah, indeed, on OGC, Organically Grown Company, we did a webinar, and we have a blog post also from Aner Ben-Ami on our website. If you go to resources, you'll be able to find there a bunch of the information and some of the considerations around multi-stakeholder versus employee ownership piece. Okay, so let me address this quickly, and then we're almost up at time. I'm happy to go on, as you know, for a long time, but I just want to say, again, in the spirit of this starting a race, there are a few things that came up for us that I think would warrant much further exploration beyond what we were able to do here. So one is the opportunity for a legal structure, a new legal structure that could encourage investment in the worker-centric employee ownership space. There's a lot of restrictions around ESOPs, as Camille said. They're heavily regulated by the Department of Labor. There have been concerns around the possible later intervention, if I remember correctly, right, and the auditing of the transaction that doesn't give the level of certainty that some of the private equity fund managers like to have around transactions. We would like to see some work done around the sort of bringing together the impact metrics from quality jobs, such as the work that Aspen is doing, or the Good Jobs Institute up at MIT, with the employee ownership impact metrics specifically. If we look at this as really being meant to spur a movement of investments that sit in that either narrow or wide band of something that might look like private equity, might even sit within a private equity allocation, but it's really fundamentally rooted in this transformative approach for employee ownership, we might want to get some really solid case studies documented. So again, if any of you has historical information or current information of this PE and ESOP model being done from a worker-centric perspective, we would love to see those and put them even in an annex or a reissue of the paper. The protection of the worker interests and worker representation in the conversion process, right? What the recommendations are around that, which again, from our review so far, are kind of floating around. And one area that we at Transform Finance have started looking at is that ultimately, while this is a fairly big pipeline of transitioning companies, the working landscape is also changing, and there is an increasingly contingent workforce out there. And we're starting to explore some strategies for creating employee ownership or employee ownership-like opportunities for the contingent workforce. So that's another piece that we'd love to workshop with you, and I imagine Greg and others in the general space of platform co-ops, for example, have been looking at. Scott, can I turn it over to you or Camille for any additional thoughts here or things that you'd like to bring up?
I would just quickly, once again, congratulate you guys. And having looked at the scope and the scale of the questions that have come in throughout this session, I see, a lot of interest and some very sophisticated questions that lead me to believe that, we're not alone in this quest. And there can be some very good partnerships coming out of this conversation. Probably some exist already. And, hopefully we can start to test some of these ideas in practice. I'll leave it at that because I see we're 1 minute over already.
Yeah, no, I just appreciate you, Scott, and the team at OSF for giving us a platform to really, we've been wanting to look at this forever, and I think now is the time, and we really appreciate you all helping us with the resources to do that. So much love to you all at OSF.
Great. Thank you all. So we'll officially close. If anybody else would want to say anything else, I'm happy to stay on the line a little bit and hear the rest of the conversation. Thank you to Scott. Thank you to Robin, who was not able to join us today, for really helping us frame this work in the broader context of open and equitable societies. And thank you to all those that were listening in. If you have more in particular of the technical questions, please direct them our way, because we would love to tighten up a little bit some of the great technical questions that the PE folks on the line have brought up, some of the stuff that Chris Mackin always, is one step ahead of us in asking questions. So bring them our way so that our work can continue to improve. So Great. Thank you all for joining us, and do sign up for the next one. And we will share with you some of the information I see that John from Social Capital Partners was trying to share, but had some sound issues with in the follow-up email with the recording. Thank you again for joining us. Have a good one.
Thanks, Joe.